All right, something really strange is happening in the Vancouver real estate market right now, and I don't mean the usual stuff. Slow sales, price corrections, rate sensitivity. I mean developers are going broke mid-construction. Projects that cost hundreds of millions of dollars are sitting half-finished, foreclosed on, with buyers desperately trying to get their deposit back. Today, we're going to be breaking down exactly what's happening behind the scenes in Canada's development market, because the numbers are a lot worse than what's making out to be in the headlines. And I'm going to tell you why, even with the new government incentives that just came out, the developers might not be saved. Let's get into it. The numbers first. Distressed real estate sales across Canada are surging, and I mean foreclosures. I want to give you actual data here because I think it puts things in context. In 2023, there were about 119 distressed sales. 2024, that number went up to 191. 2025, 252. And we're not talking about some random markets here. The vast majority of these concentrated into two cities, Vancouver and Toronto. These are the two markets with the worst pre-sale crisis right now. But here's the thing. And this is what I really want you to understand. Those numbers only represent properties that have actually sold, the ones that exchanged hands. There are a ton of other projects that are sitting in foreclosure proceedings right now or headed into them that haven't even sold yet. So the real picture is almost certainly worse than what those numbers are showing. Now, foreclosures and development aren't brand new. This has happened before. Usually it was on empty land. A developer buys a lot. They can't raise enough money to build, and then they go into foreclosure. That right there was a typical story. But what we're seeing right now is different, and I want to walk you through the projects that I think really illustrate how bad things have gotten. The Broadway Ghost Tower. The first one is in Vancouver. And if you've been in the area, you may have actually noticed it, a half-built tower on Broadway that just stopped. It was marketed as a luxury development. Construction started in 2022. They got to the 8th floor, and then that was it. They ran out of money before they could build floors 9 and 10. The National Bank of Canada is owed about $35 million on this project. The property is assessed at roughly $35 million. And that's actually currently listed right now as a foreclosure. But here's the thing. Nobody thinks it's actually going to sell at that number. The bank is almost certainly going to have to take a hit here because who is lining up to buy a half-completed 8-story tower? It's an incredibly difficult asset to underwrite and get somebody to purchase. And then there's the buyer side of this, which honestly is the part that bothers me the most. 22 of the 38 units were pre-sold. So if you got 22 people who are now in a fight to get their deposits back, and the news articles aren't really covering that part of the story. These are people who put real money down on a home they thought they were buying and moving into, or investing and renting out, and now they're caught up in a foreclosure proceeding. Having a ghost tower in the middle of Broadway is bad for the market and bad for public confidence too. But that's just one of the two projects that I want to talk about. The next one is the Richmond mega project. The second one, in my opinion, is even more eye-opening. This is a 27-acre site in Richmond that was purchased in 2021 for $300 million. $300 million. It was supposed to be a master planned community, multiple residential towers, housing developments, the whole 9 yards. And it never happened. But what makes this different from the Broadway project and from the most foreclosures in general is that this property is actually generating income. It has 78 tenants running businesses on site. It pulls roughly $11 million in revenue in lease per year. This isn't a vacant lot bleeding money every month. It's a cash flowing asset, and yet the developer still couldn't make their payments. According to reports, they owe about $188 million in this project, and the property is assessed around $244 million. So you might be thinking, okay, why not just sell it? You're underwater on what you paid, but you cover the $188 million, take your losses and move on. And that's exactly the problem. This type of project is extremely hard to sell right now. Developers across the country are trying to get out of their positions. They want to liquidate, not acquire more. So who is on the other side of that trade? Who's going to write a $244 million check for a development site in a market where developments are stalling? Nobody, at least not right now. And that's what makes this project such a clear illustration of where the market actually is. Because it's not just one small developer who got in over their head. We're talking about a massive exposure on both sides, the developer and the lender. In this case, the lender is sitting on $188 million lent out against a project that may not be nearly worth that for what it's assessed at today. So the banks are holding on to the bag. And this is where things get really interesting because there are reports coming out that saying development sites that are $50 to $60 million in debt in today's market might only be worth $10 to $15 million when you go to sell them. That's a 70 to 80% haircut in some cases. So what are the banks doing? Because normally when a developer can't pay, the bank forecloses and they sell the asset to recover what they're owed. That's usually the process. But what we're seeing now, and this is something I don't think we've seen before, is that the banks are foreclosing on these projects and then holding them. They're not selling. because if they sell today's prices, they're adding up enormous losses on their books. So they're waiting and hoping that the market recovers, hoping that conditions improve, which means that you got banks that are now essentially acting as real estate holding companies for distressed development sites that they never wanted to own in the first place. And that means pain isn't just on the developer side anymore. The major banks, the big institutions, everybody knows are taking these losses too. That's a different story than what we were telling 2 years ago. So how did we get here? I've done several videos now on Vancouver pre-sale crisis specifically, so I won't go too deep on this, but here's the quick version. Interest rates went up significantly, construction costs surged because inflation, and more recently, tariffs. And the investor class, which was the backbone of the pre-sale market in Vancouver, largely exited, if not just Vancouver, out of the country. So get this, only about 5% of pre-sale unit buyers are first-time home buyers. 5%. Something like 70% of units sold in the pre-sale market historically went to investors. So when investors pull back, and they did, big time, you essentially lose the entire demand base that was funding these projects. Developers typically need around 70% of a project to sell before they get financing approved, and they can start construction, and they're just simply not hitting those numbers. That's why projects are getting canceled before they even break ground. The GST rebate, definitely good news. So now the government did recently announce some good new incentives. There's a GST rebate for first-time homebuyers purchasing new construction under $1 million. And a partial rebate is also available for up to $1.5 million. And look, that's not nothing. On $1 million property, you're saving around $50,000. That's a real difference in terms of real cash and what they have to come up with. But here's the thing. Developers themselves are saying this doesn't really move the needle. And I actually think that they're missing the point when they say that, because this program isn't designed to bail out developers. It's designed to help first-time homebuyers get into the market. So those are completely different goals. The issue is that first-time homebuyers in Vancouver still overwhelmingly prefer resale over new construction. And there are two big reasons for that. One, even with the GST relief, resale units are still significantly cheaper than brand new construction. The gap is large enough that the rebate doesn't close it. Two, these pre-sale condos tend to be smaller with layouts that were designed for investors, not for people who actually want to live there. First-time homebuyers want more space, bigger floor plans, something that actually fits their lifestyle. And a lot of what's out there in the pre-sale market wasn't built with the buyer in mind. So while GST rebate genuinely helps some people, it's not a solution to the developer crisis. The developers know that, and the experts know that. What comes next? Here's the part I don't want to gloss over. According to a number of reports and experts in the space, we're not at the bottom yet. Not for the pre-sale market. The expectation from a lot of people watching this closely is that we're likely to see more project foreclosures through the end of 2026 and well into 2027. And if you layer that on top of the ongoing geopolitical uncertainty, the possible that interest rates could continue to rise higher expected, you've got a picture that doesn't get dramatically better in the short term for developers. Now, to be clear, this is not a collapse of the entire real estate market. Resale is a different story. The detached home market in parts of Metro Vancouver is actually showing signs of life, but the presale and development side is in a real period of pain. And I think it's important to be honest about that rather than pretend otherwise. I'll keep covering this as it develops. And if you're in Greater Vancouver and you want to talk about any of this, means for you, your specific situation, whether you're buying or selling, if you're sitting on a pre-sale contract and wondering what your options are, reach out. My contact info is in the description. If you got value out of this, hit the like button, hit the subscribe. It genuinely helps this channel grow and makes me more motivated to continue to film for you guys. I'm Blake Chancey with Real Broker. We'll see you on the next one.